If you are a stock investor, you have certainly come across headlines highlighting how overvalued, how wildly overvalued US stocks are. However, in this video, I'm going to make the case that the US stock market is not as overvalued as it may optically seem. So let me explain why after rolling the intro. Alright, so I think I'm going to title the video "The S&P 500 is not as overvalued as you may think." And as I said in the introduction of the video, it doesn't take you long to find headlines suggesting that the US stock market is trading at prices that will lead to very disappointing returns going forward. And to be fair, I've made a similar point in some of my previous videos. I think the US stock market is not cheap, especially certain names in the S&P 500. However, there is a case to be made that the US stock market as a whole deserves to trade at a much higher multiple than other regions, but also than the US itself, the US stock market itself did in the past. So maybe before we get into the numbers, because I came across a truly fascinating chart the other day, just today in fact. But before I discuss it and the takeaways from analyzing that particular chart, let me just show you one of the charts I was quickly trying to find before hitting the record button. So this headline here, for example, is taken from the Wall Street Journal, and it states, "Is this wildly overvalued stock market doomed? Yes, but maybe not yet. History shows no link between nosebleed valuations like today's and next year's returns." And basically the author is already indicating here that he believes the market is trading at quote-unquote nosebleed valuations, which if you look at the historical price to earnings ratio, the development of that metric of the S&P 500 over time seems to be true. So as of today, the S&P 500 is trading at a price to earnings ratio of around 30, which compared to the historical mean, 16 times earnings, is almost twice as high. So of course, it makes sense to assume that the US stock market is trading at quote-unquote nosebleed valuations. However, I don't think that's necessarily the case. And I'm now going to transition to explaining why. So I came across a chart, as I said, and this chart was taken from a report published by JP Morgan. And the report was called "Eye on the Market, Outlook for 2025, The Alchemists." And basically, I may show it on screen for you right now. The report consists of a bunch of different charts on all sorts of topics. Some of them are particularly interesting for fundamental investors. Others are maybe more macro trend oriented and do not really bother me all too much. However, this chart here, this one is an incredibly fascinating chart if you ask me. It shows the free cash flow margin by decade for the 10 largest stocks. So those would be the 10 largest stocks in the US in the S&P 500. And what you can see here is a consistent upward trend. So as of today, in the 2020s, the 10 largest companies in the US post a free cash flow margin, and free cash flow is all that matters to fundamental investors, a free cash flow margin above 25%, which compared to the historical numbers is staggeringly high. So if we go back to the 70s and 80s and also the 90s, back then the free cash flow margins were only around 10%. In the 70s and 80s, even below 10%. So what does this mean? This means that fundamentally, the largest companies in the US today are much better businesses than they were in the past. I will say that this whole discussion probably needs to be a little more nuanced than I make it seem here. Higher margins do not per se mean higher business quality, because there are other factors to consider, such as capital velocity, but then we get into really nuanced concepts, advanced concepts that I cannot really cover on this channel, because then I will lose too many viewers along the line. But generally speaking, if a basket of stocks posts 25% free cash flow margins compared to a basket of stocks, of 10 stocks, that only post free cash flow margins of say 8 to 9%, well, the first basket is going to be a much higher quality basket. And if you understand valuation, you will know that optical, simple valuation multiples, like the price to earnings ratio, that's not valuation work itself. However, they are a shorthand for more granular valuation work you could do. And obviously, the cash generation capabilities by businesses is one ingredient determining what a quote-unquote fair multiple would look like. And when I say fair multiple, that basically means that this multiple reflects that you can earn the return that you demand from your investments. So if we just go back to the price to earnings ratio chart of the S&P over time and then put it next to the free cash flow margin chart I was just talking about, well, then there may be an underlying reason for why the S&P is now trading at a higher multiple. And that doesn't necessarily mean that the S&P is more overvalued today. Let me also just show you another chart here that is showing some of the largest companies in the US and their individual free cash flow margins. So what you can see here is that Visa is posting free cash flow margins of around 60%. Then we've got Nvidia with margins around 44%. We've got Meta, Microsoft, Apple. They are all posting free cash flow margins in the high 20s, low 30s. So incredibly high free cash flow margins, which of course reflect superior business quality. All right, just to quote someone who is also an expert when it comes to stock investing, Theo Berkran, he was basically describing in his words what I was just trying to describe. You cannot compare the price to earnings ratio of the S&P from the 1950s to the price to earnings ratio of the S&P today, because, to quote him here, the statistical properties of the underlying population, and those would be the underlying stocks, have changed over time. And this was reflected in the free cash flow margin chart that I just discussed with you. And then he continued to explain you can only correctly compare today to the past if the statistical properties of the underlying index are the same or stationary, which they aren't. And then he brings up another point that I'm not going to cover in detail here, but basically he highlights that today's businesses, they are more or rather reinvesting for growth via the income statement, via research and development, via marketing spending, via their headcount, and less so via reinvestments into physical goods and an expansion of the production facilities, stuff like that. Speaking of the properties of the underlying components of the S&P, I also wanted to show you this chart taken from the same report. It shows that the Max 7, so some of the biggest components of the S&P, they have simply grown their earnings per share at a much faster clip than the rest of the S&P 500, which again, growth is one critical component of value, and it might highlight or explain why the S&P right now is trading at a quote-unquote elevated valuation multiple. That elevated multiple may be justified due to higher margins, due to higher growth than we've seen in the past. All right, that should already be it for this video. Let me know what you think. Is the US stock market and the S&P specifically overvalued right now or not? Or does the current PE multiple of the S&P, which is standing above, significantly above its historical mean, only reflect higher quality and a higher growth outlook for some of the biggest components of the S&P? Take care.